One of the more common ratios that you'll use is the gross profit margin. In layman's terms, this shows you the amount of money your client is making per dollar on every sale of a good or service before you factor expenses or taxes. Essentially, it shows if a business is getting a reasonable return for what it's selling. Now, from a business owner standpoint, when they know the gross profit margin, they can determine if what they're making per dollar is in line with what other similar businesses are making. If not, then they can start thinking about how they make adjustments. So, how do we calculate a company's gross profit margin? Well, I'm gonna show you. First, we need some numbers to work with. Here. Let's use my friend and client, Claire. Now, here's a recent income statement that I whipped up for her. Now, to figure out Claire's gross profit margin, we need to subtract her sales revenue from her cost of goods sold, and then divide that number by the sales revenue again. That should give us the percent of every dollar that she keeps as gross profit. Here, let's take a look. Based on our ratio formula, it looks like Claire has a gross profit margin of 65%. Not too shabby if you ask me. I know that's a lot, so let's hear from one of my experts.
Gross profit margin. What makes that up? Of course, that is income minus the cost of goods sold, or revenue minus cost of goods sold, gives you your gross profit margin. This is a really important number for a lot of businesses. So if you imagine a retail store as an example, you have sales minus the cost of those sales gives you your gross profit margin. A lot of industries are going to have some type of percentage or ratio that they're looking for. They might be looking for 30% or 70% or 50%. That's a really important number for them because it lets them know if their sales are high enough, if they're discounting too much, all of those types of things, or perhaps their inventory is costing more than they anticipated when they're selling. So that gross profit margin is a really important number. Now, for a retail store, that they live and breathe on that. In a lot of industries, they know that really well, but there are some industries, especially service-based industries, that might be really important for them to understand as well, especially if they are using contractors to help serve those clients, or if they can attribute some of their labor costs directly to the delivery of those services. That number could be really important for them and something they've never tracked before. That can be a really big value that you add to that client as you're explaining that to them, so that they understand that they too have a gross profit margin. If we had no clients whatsoever, our gross profit would be zero. If we have no sales, there's no cost of sales, therefore your gross profit margin is zero, and then everything below that is their overhead. It is the things that keep the doors open, virtually or literally. And so understanding that is really helpful. And of course, having just gone through perhaps a global pandemic and they just had to keep their doors open, that is a really important number that a lot of clients are looking for. So again, that gross profit margin is sales or revenue minus the cost to produce those sales or revenue. That is your gross profit margin. Then the rest of that profit and loss statement is going to be their operating expenses. And that's really in many ways their overhead that gets them to their net profit.